Hey everyone, today I wanted to share a quick tutorial again on how to collect rents from pretty much any stock. So today I want to focus on Intel. I think it's a good candidate for the strategy. It's on the lower end of its valuation range. I think it's fairly undervalued right now, and it's a pretty stable company. It's making real money, real cash flow, and so I think there is a limit to how far down it can go. And these are the type of stocks that work well with this strategy. In my other videos, I mentioned that this is what I call the AirBNB Options Trading Strategy. Trying to come up with another name for it. The only thing I could think of was something like the Options Rental Income Strategy, something like that, right? But this is a way that pretty much anyone can make some extra dollars on the side. The risk is somewhat limited in my view if you pick the right stocks. And you kind of learn the ins and outs of this strategy, which I do teach people. So if you're interested, then comment below. Anyway, so as you can see, Intel here, my favorite tool, Finbox, shows a fair value of $68, which is a 50% upside from current prices. And if we look down at kind of some of the metrics here, revenue growth is slow, right? Still slightly positive, but maybe the most important metric to me is kind of their free cash flow, this levered free cash flow. Unlevered, this is a topic for another day. Look at both of these, but let me click into this. You can see they've had quite a accelerating cash flow lately, but then it dropped off significantly. Cash flow can be lumpier than earnings, right? Like if I looked at the, let's look at their earnings. Let's see. Earnings per share. Earnings per share a little bit more steady, right? So trading around $470, $480 a share in earnings, which means at, what is it? Currently it's $45, $46 stock. Yeah. That means, less than 10 times earnings, right? But cash flow, really, at the end of the day, what matters is earnings can be manipulated in some ways, and so cash flow is really the best metric in my mind of whether the company is making money. And as shown, there was a big dip last year, but that could be temporary. So I would say kind of pretty steady state, 15 billion to 20 billion is realistic. And if I look back at the enterprise value, meaning the cost of the entire company if you were to buy it, like if you were an Elon Musk or Warren Buffett and wanted to buy this company completely, it'd be 187 billion. If you're generating 20 billion in cash flow per year in a normal year, then it's less than 10 times cash flow as well, free cash flow. So I think we've established that I think it's fairly undervalued, and so downside from here, it's also towards the 52-week low. So I think downside is pretty limited. These are the different valuation models. They're all above $60, right? Some ratio models like PE, price to book, price to sales. Then you've got your DCF models down here. All of them are concluding a fair value of over $60. Now, let me flip over here to my Thinkorswim. And so here is the proposed AirBNB options strategy to generate rental income from Intel. Now, let me show you the chart really quick. Earnings are coming up soon, I think on the 28th. So normally I don't like to start a new position on a stock right before earnings. But since it is already at the low end of its range, it's kind of been in this channel here for quite some time. This is, I think, a 3-year chart. I think there's pretty solid support around this $43, $44 level down here, so we don't have much downside, in my opinion. And then this trade that I'm proposing, it's really a diagonal spread. But you're buying a longer duration asset and then generating rents off of it by selling a shorter duration asset. So we're buying a deep in the money call option, in this case the $30 January 2023 call option, and then we're selling, if you can see this small print, the 13th of May, that's 28 days from now, $46, which is the at the money call option. If I just show you that on the options chain, here's January 2023, we'd be buying this $30 call option. We could go out to June, right? And actually, I do like to stick above it 1 year if I can on the long duration asset. So if I do that, it actually doesn't increase the price much, right? It went from 14.35, I believe, to 14.65. Yeah, so only 30 bucks more. I'd go ahead and go with the June. So you have a year and 3 months before this one expires. And then you're selling typically around a 30 days to expiration option, 30 DTE. So I selected the 13th of May. I like to sell at the money. That's where you get the most. This is extrinsic value, this column here. So you get $1.82, but with options contracts, you got to multiply it by 100. So it's $182 you collect selling that 46 near-term call. And so when you look at the risk profile, this is the profit loss graph. You can see right at $46 is where your peak profit is. And you would make $198 because you're collecting that $186 of premium, plus the stock would appreciate by a few cents. So you make a little bit of extra money. So you make $197 at the peak. And with diagonals, because the long option gives you like typically 85-90% of the upward movement, not a full 100% of the upward movement, you do have this droop as the stock price goes up. In this case, it's not too bad, and you actually level out once you get to above $53. So all I'm trying to say is you make money anytime the stock is really above 43.66 over here. This is the break even, that little red mark here. Peak profit is going to be right at $46. That's the call you sold. And then, out to infinity, you'll always make at least $135 if it's way up here. And your downside, obviously, right, is the amount you pay for this diagonal. So you can see if I go all the way down to zero, I mean, my max loss is going to be that the $1,465 that I'm spending for this diagonal spread. So that's the trade in a nutshell. You can see you generate over a 10% return at the peak, and even at the non-peak on the upside, you generate 135 bucks, which is 8% return, right? In 1 month, less than 1 month, 28 days, which is pretty good, right? You tell me what other investments, what other asset can you earn 8 to 10% or more on in 28 days? And what's the worst case scenario? Let's say the stock does drop. There are strategies to recover from that. One of the popular strategies is to actually put another one of these trades on. Maybe you buy another 30 call. So you have 2 now, and then you can actually lower the strike for the next month that you sell. You said you would sell 2 of them. But I'll save that recovery strategy for another video. I just want you to know it's actually not as scary as you think on the downside, because if you buy the right stocks, the downside is limited and usually temporary. We're going through a correction phase right now. It won't last forever. If you're buying solid companies, real businesses with real cash flows, there's a limit to how far they can go down and for how long they can go down, right? And so at some point, you're giving yourself over a year. Hopefully the stock is at least at the same spot it is today or higher. And the odds of it being lower, especially when you do the homework on the front end, it's pretty low. And every month you can sell more premium, effectively reducing your cost basis in your long, deep in the money call, right? Like if I look back here, the option changes to show you exactly how much I'm paying for that June call, the 30 call here. I'm paying about, $1,650, right? This trade is less because it's being offset by that short call. But if I sell, $150 of premium every month, within 10 months to 12 months, I've paid off the cost of this long call. And if it's still deep in the money, then the value of it is all profit, right? So if you're interested in more of these videos, subscribe and hit that like button, and I'll just keep cranking them out. Thanks.